You're probably losing money right now, not because you're reckless, but because no one taught you the game the wealthy have been playing for decades. That dream vacation? Gone. Early retirement? Slipping away. All because you're stuck in a system designed to keep you guessing. But here's the twist. Smart investors don't pick stocks. They pick the right funds. In the next 10 minutes, I'm going to show you exactly how the 1% use funds to grow wealth silently, while most people chase shiny objects and lose. We'll break down index funds, mutual funds, hedge funds, ETFs, what they are, how they work, and which ones actually protect and grow your money. No jargon, no hype, no sales pitch. Just the unfiltered truth about where your money should and shouldn't go. Quick note, this isn't financial advice. It's the playbook I wish someone handed me years ago. Let's break the system down and finally beat it at its own game. So, what exactly is a fund? Imagine you and your friends are throwing an epic birthday party. Instead of one person handling everything, hey, each of you contributes some money to a shared pot. With that pooled budget, you can afford amazing food, drinks, decorations, entertainment. No single person has to cover everything, and everyone gets to enjoy the full experience. That's exactly how investment funds work. A bunch of people, it could be hundreds or thousands, pool their money together. Professional managers then use that money to invest in different assets like stocks, real estate, or bonds. Instead of stressing about which individual companies to invest in, the fund handles it for you. You simply own a slice of the whole pie and share in the returns. Pretty cool, right? But not all funds are created equal. Let's break down the different types. First up, index funds, which are probably the most talked about amongst top investors and wealthy figures like Warren Buffett. But what does that actually mean? An index fund is like a robot that doesn't try to outsmart the market. It simply copies a specific list or index of companies. Take the S&P 500, for example. It's a list that tracks 500 of America's biggest, most established companies. When you invest in an S&P 500 index fund, you're essentially buying tiny pieces of all 500 companies in one go. There are indexes for everything. The Nasdaq focuses on tech giants like Apple, Microsoft, and Amazon. The Dow Jones tracks 30 major companies across different industries. There are even specialized indexes for small companies, international markets, or specific sectors like healthcare. The beauty of index funds is that they're passively managed. There's no hotshot manager trying to pick winners. They just follow the index. And that's actually a good thing because it keeps fees incredibly low. Most index funds charge what's called an expense ratio of just 0.02% to 0.20% annually. That means if you invest $10,000, you might pay just $2 to $20 per year in fees. That's nothing. Some big names in index funds include Vanguard, BlackRock's iShares, and Fidelity. One important thing to understand about index funds: unlike stocks, either you can't buy or sell them at any time of day at the current price. They're only priced once daily after the market closes. That price is called the net asset value. So if you place an order at 10 a.m. or 11 a.m., it won't go through until after the market closes, typically at 4 p.m. For long-term investors, this isn't a big deal, but it's something to be aware of. Next is mutual funds. At first glance, they seem similar to index funds. They both pool investors' money and spread it across multiple assets. But here's the big difference. Mutual funds are usually actively managed. That means there's a professional fund manager, sometimes an entire team, actively deciding which stocks or bonds to buy and sell. Their goal? To beat the market by picking the right investments at the right time. Sounds great in theory, right? But here's the catch, and it's a big one. Active management comes with much higher fees. Mutual fund expense ratios often range from 0.5% to 1.5% or even higher. On that same $10,000 investment, you could be paying $50 to $150 per year, sometimes more. And here's the kicker. Studies consistently show that most actively managed funds don't beat the market over the long term. In fact, after accounting for those higher fees, many perform worse than simple index funds. That said, some people prefer mutual funds because they believe in a specific manager's strategy or want exposure to certain sectors that might not be available through index funds. Major mutual fund providers include companies like Vanguard, Fidelity, and JP Morgan, offering both actively and passively managed options. Now let's talk about hedge funds, the investment vehicles you've probably heard about in movies like The Wolf of Wall Street. Hedge funds are a completely different animal. They use aggressive, complex strategies like short selling, betting that prices will fall, leverage, borrowing money to invest more, derivatives, and other sophisticated financial instruments, all with the goal of generating massive returns. But here's the thing, hedge funds aren't for everyday investors like you and me. They're typically only open to accredited investors, basically wealthy individuals or institutions with millions to invest. And the fees? Hedge funds are infamous for their 2 and 20 model, a 2% annual management fee plus 20% of any profits the fund makes. That's astronomically higher than index or mutual funds. With those kinds of fees, hedge funds need to aim for much higher returns, and that often means taking on significantly more risk and volatility. So unless you're sitting on several $1 million and have a high risk tolerance, hedge funds probably aren't something you need to worry about right now. Finally, let's talk about ETFs, or exchange-traded funds. These are often described as a hybrid between index funds and individual stocks. Like index funds, ETFs give you instant diversification by pooling investments across many different assets. But like individual stocks, they trade throughout the day on stock exchanges. This means that you can buy and sell ETFs whenever the market is open. You can see their prices change in real time. You can decide exactly when to buy or sell. Based on current prices, ETFs also have low fees, typically ranging from 0.03% to 0.75%, generally lower than actively managed mutual funds. Most ETFs are passively managed, following an index just like index funds do, but their stock-like trading flexibility gives you more control over exactly when you buy or sell. Plus, many brokerage platforms now offer commission-free ETF trading, making them incredibly accessible to investors of all levels. So, what's the bottom line? Which investment fund is right for you? For most everyday investors, especially beginners, index funds or ETFs are usually your best bet, and here's why. They're low cost, keeping more money in your pocket. They're simple to understand. They offer broad diversification to reduce risk. And historically, they've performed well over the long term. Even investment legend Warren Buffett recommends index funds for most people because it's incredibly difficult to consistently outperform the market. Mutual funds might make sense if you believe strongly in a specific fund manager strategy or want exposure to niche markets. Just be aware of those higher fees eating into your returns. And hedge funds. Unless you're already wealthy and comfortable with higher risk, they're probably not on your radar, and that's perfectly fine. Remember, the most important investment decision isn't picking the perfect fund. It's simply getting started and staying consistent. Even small amounts invested regularly can grow into something significant over time. If you found this breakdown helpful, please hit that like button and subscribe for more straightforward financial education. Drop a comment with any questions or topics you'd like me to cover next, and I'll see you in the next video. For now, I recommend watching this video where we expose weird budgeting hacks that actually work. No apps, no bullshit.